morning, and welcome to this month's OakCrest Insight. I'm Steve Brill, Investment and Portfolio Associate here at OakCrest. With market volatility ramping up the past few weeks, we wanted to give some insight and context on what happened and what our views currently are to give you some comfort as you listen to the media's perspective. Today, I'm joined by Ryan Nieder, CEO here at OakCrest. Ryan, could you please recap the last few weeks of the markets for us?
Certainly, Steve. There's been a lot going on the last few weeks. The first week of August, big economic indicators started coming out that were updated unemployment rates and earnings of companies. What really surprised or caught investors off guard was a higher than expected unemployment rate of 4.3%, and really many companies, Steve, not hitting earnings expectations. Corporate fundamentals are strong, they're solid, but investors set this high bar for many companies coming this summer. Now, on top of this, in the same week, the Fed wasn't ready to lower rates yet. And they told investors to really start being patient. Powell was dovish and asked for patience, but the markets want quicker action as calls of a policy error start growing. If all that wasn't enough in 1 week, on Monday, August 5th, the U.S. market dropped, Steve, 3% in 1 day, compounding that effect from the short downturn the last week of July.
Ryan, you just mentioned the U.S. market being down so much on August 5th and overseas indices down by nearly 10% that same day. What caused the market to drop so much in 1 day?
So stay with me. This is a hard one to understand, and it really doesn't happen very often. But what happened is what's called a carry trade, where an investor borrows in a currency with low interest rate. In this case, it was the Japanese yen, which was at 0%, and then reinvests that money in higher yielding assets elsewhere, like the markets here in the US or treasuries. In simplistic terms, large institutional investors were borrowing at 0%, getting 4+% somewhere else, and generating a positive carry. Now, Japan has kept rates low for 17 years, Steve, for institutions to do this. And then the last week of July, August, caught investors off guard by raising them. This change caused institutions to unwind and really sell the assets they had invested to pay off the borrowed money.
You just mentioned so much happening in the economy the last few weeks. What's our current outlook and takeaway for clients, Ryan?
So there's a lot of opinions out there, Steve. Everything we're hearing, though, is that volatility should pass reasonably quickly and not to panic. So the market was down 3% on a Monday, but by a few days later, the market really had recouped most of those losses last week. The job market is still very solid, and we expect the economy to continue to grow. So patience is key. Expectations with how much the economy had grown the last 18 months was way too high to sustain. And the economy is slowing down. The media, though, is talking about a recession. But from our conversations with economists right now, a recession is not imminent. What we're watching right now is how quickly the Fed will lower rates to satisfy what the markets would like them to start doing. Now, we wish it had been done sooner this summer, Steve, right? Lower rates maybe June or July like they originally started talking about or expected. But this, along with trillions of dollars sitting on the sidelines to be deployed back into our markets, should continue to help grow our economy. Another bright spot for the economy is that mortgage rates are starting to fall. In high of April, they were at 7.52%. Now they're in the sixes. I've heard some people talk in the fives. So this is great news for those looking to move.
Thanks so much, Ryan. We know there's a lot of headlines in the media right now with the market volatility, economy, and looming presidential elections. Next month, we'll continue to update you on our views. We want you to be a partner as we get through these times like now, so feel free to contact us if you have any questions or concerns about your specific financial situation.
We look forward to seeing you next month on OakCrest Insight.